Welcome to the second and last of my short series on the history and application of ratings' indirect methods of valuation. Today, the receipts and expenditure or profits basis. The problem this time is the same as it was last time when we were talking about the contractor's basis. We're trying to model in economic terms a transaction that never happens in the real world, and the reason why it never happens in the real world are economic reasons. As with the contractor's basis, it's not possible to proceed from starting point to destination by smooth steps of unimpeachable logic. There is bound to be a degree of artificiality and a need for hypotheses of a more or less violent character. With the receipts and expenditure method, which used to be known as the profits, the journey is from information about the performance in the period leading up to the valuation date of the business actually carried on from the subject hereditament to the destination, a rent, which is it's assumed that reasonable hypothetical parties would agree. A characteristic of the history of both methods, profits and contractors, is that from pretty rudimentary, rough and ready beginnings, ratepayers and those charged with setting rateable values have been on a continuous process of refining, polishing, and hopefully improving the method and its application. Over the years, the courts have filled the largest and most obvious gaps in the process with some bold counterfactual assumptions. And in that context, we shall spend some time on the Southern Railway with Lord Hailsham, the first Lord Hailsham. But the circumstances of modern hereditaments raise issues that remain unsettled and which, to be resolved, will involve the decision maker in some sort of distortion or counterfactual assumption. In preparing and presenting a case, you want to pull off the trick of offering the tribunal a distortion more attractive than the one offered by the other side. So it is sensible, I think, to take from previous decisions what guidance we can about the factors to which judges respond positively. I want now, as my final piece of throat clearing, to identify the major features by which courts, major feature, singular, by which courts and tribunal judge between competing artificialities. As we go along, we'll see its application in practice. For this purpose, I draw attention to two dicta, both on a similar theme. In the Queen and Grand Junction Railway Company, not on the screen, Lord Denman explained that the supposition of a tenancy is only a mode of ascertaining the existing value of the occupation to the existing occupier. And in Townley Mill, against the Oldham Assessment Committee, which is Lord Justice Scott, and this is on the screen, said that the function of rating valuation is to ascertain the value to the existing occupier. The hypothesis of the imaginary tenant is intended to help and not to hinder the just enforcement of the primary obligation. If it hinders, it must pro tanto, to that extent, be treated as inapplicable. So there may be arguments which can plausibly be constructed from premise to conclusion, but which are nonetheless likely to fail because they use the hypothesis of landlord and tenant, either to inflate or reduce the rateable value as compared with the judge's gut conception of the value of the occupation to the occupier. The receipts and expenditure cases are littered with examples that tend to support that blunt proposition. It is the single common theme that best explains how and why the method has developed in the way that it has. I could start earlier, but I start in 1844 in the parish of Seaford in Staffordshire. This is the Grand Junction Railway case I mentioned a moment ago. The company operated a railway network of 136 miles, together with stations, sidings and so on, with termini at Birmingham, Liverpool, Manchester, Crewe and Chester. 1.5 miles of track passed through Seaford. where there was no station or other stopping point. That 1.5 miles of track was the appeal hereditament. Because other train companies used the track and paid tolls for the privilege, Grand Junction was able to calculate that in the year up to the date of the rate, the tolls paid, together with an allowance at the same figures for their own use, the tolls paid that were attributable to that 1.5 miles amounted to £1,500. That led Grand Junction to calculate an annual value of £710, 10 shillings. And they derived that by deducting from the gross yearly receipts 20% for tenants' profit, 2.5% for the cost of collecting the tolls, and sums variously per mile for operating cost, rates, repair renewal of sleepers and other perishable parts of the hereditament. Albeit that to modernise the valuation is upside down, because it deducts the tenant's share from revenue rather than deducting it from the divisible balance, that's clearly a receipts and expenditure valuation. The parish officers, court of sessions and the divisional court took a different route to net annual value. They started from the gross receipts in the year up to the date of the rate of the whole enterprise, the 136 miles serving Birmingham, Liverpool, etc. From that, they deducted 5% of the costs of movable stock, or tenant's capital, 20% of the same sum for the tenant's profit, 12.5% on the same sum for depreciation of the tenant's assets, a sum for operating expense, another representing the annual value of stations and other buildings, and another sum for repair, renewal of sleepers, etc. It was agreed that if this were the correct approach, then the resultant figure, which was some £135,000 or so, should be apportioned between the various hereditaments on the basis of per mile of track. And that led to a value for the appeal hereditament, not of Grand Junction's £710, 10 shillings, but of £1,050. Again, notwithstanding that it takes the relevant steps in a different order, that looks like a receipts and expenditure valuation we'd recognise today. I draw attention to this case for a number of reasons. First, because it's a window onto a Victorian world that looks more similar to our own in many respects than we might expect. Secondly, it shows that the receipts and expenditure method, as we now call it, was established and generally accepted nearly 180 years ago. Thirdly, it indicates classic circumstances in which the method was applied in those days to value a network in cumulo, that cumulo then being apportioned amongst the hereditaments parish by parish. Next, that it was an attempt by the ratepayer, which proved unsuccessful, to avoid the effect of the apportionment of the cumulo by volunteering a method that generated for the particular hereditament a value lower than indicated by apportioning that cumulo. And finally, because it contains, without anybody mentioning it, a paradox that characterized profits cases for a long time. The paradox is this. In the course of giving judgment, Lord Denman said that the starting point is in ascertaining how much net rent an occupation may be expected to command, parish officers are to consider all the existing circumstances which would reasonably influence the parties to a negotiation for a tenancy as to the amount of rent to be asked or given. So he clearly had in mind a negotiation about a tenancy that is about to begin. Nonetheless, as we have seen, the value was derived by means of a calculation that wasn't forward-looking, but founded solely on the previous year's accounts. 19 years later, 1863, the rateable assets of the Sheffield United Gaslight Company fell to be assessed. The ratepayers' attempt to persuade the court to an alternative method failed, and a profits basis valuation prevailed. By this time, the order in which features were taken into account in the valuation was turning towards the more familiar, in that OPEX was deducted from gross receipts before assessing the deduction for the tenant's share. But again, the figures were derived without adjustment from the accounts of the actual operator for the year immediately preceding the making of the rate. The court did not consider the process satisfactory. And this is what Mr. Justice Blackburn had to say. The whole subject matter appears to be involved in so much difficulty and uncertainty that we've taken much time in considering whether we could not place the rules as to the rating of these companies on more intelligible and satisfactory principles, and which should be capable of uniform application. We have not, however, succeeded. Pausing there, it's apparent that by 1853, a method of valuation that started from the receipts of the actual occupier in the year immediately prior to the making of the rate, deducted therefrom operating expenditure, depreciation of tenants' assets, a sum to reflect the tenant's liability to repair the hereditament and keep it in a state to command the rent, a sum to reflect the tenant's investment and risk and profit, and arrived at annual value. That method was firmly established, even though the courts considered it an artificial means to answer an impossible question. I turn next to Kingston Union and the Metropolitan Water Board in 1926. In one way, this was the mirror image of Grand Junction Railway, in the sense that the rating authority, the Union, were attempting to escape from the regime of apportioning the cumulo value, this time to arrive at a value higher than apportionment of the cumulo indicated. In the last talk, when I was talking about the contractor's basis, I drew attention to some cases to do with water supply hereditaments, and I described them as contractor's basis cases, which they were, notably the reservoir in Liverpool and Llanfwllyn. What I didn't mention was that those cases form part of a wider analysis of water undertakings. The whole network was valued in cumulo by means of the profits basis. It was then looked at in parts. The directly productive parts, as they were called, such as the pipes that actually delivered water to customers, they were distinguished from the indirectly productive parts, such as reservoirs. At the time of Llanfwllyn Union, the indirectly productive parts were valued using the contractor's basis, and those values were deducted from the cumulo. The remainder of the cumulo was then apportioned to the directly productive parts according to the revenue achieved in each parish. In Kingston, the approach appears to have been slightly different in that the cumulo was apportioned entirely by reference to the structural value of the whole, directly and indirectly productive parts. The percentage that the cumulo value represented of the structural value of the whole was applied to the structural value of each hereditament, thereby ensuring that the total rates paid were based on a value that did not exceed the total rateable value of the whole set of assets. One of the complaints of Kingston was that the effect of this arrangement was that instead of values being based on the standard percentages of 4% on land and 5% on buildings, they were actually only getting 2.5%. That's the way the calculation worked out. And they said that the subject hereditament should be valued on the contractor's basis at the standard percentages. The stating of the grievance in that way also shows, it seemed to me, why the court rejected it. The profits basis seeks to identify what the hypothetical tenant can afford to pay. If the rent is so high as to prevent the tenant making a commercial return, then the tenant will politely decline to enter into the tenancy. So where the subject hereditament was part of a network occupied for the purpose of making a profit, there was a real danger that in valuing it on the contractor's basis, without regard to the returns of the undertaking as a whole, then the total rateable value would equate to a rent greater than the hypothetical operator could bear commercially. And on that basis, Lord Cave expounded the rule that in the case of waterworks, the profits basis had to be applied as a matter of law in the absence of special circumstances. And over time, the application of the rule was expanded to all public utility undertakings. Now, the usefulness of the rule expired in 1990, when the networks which had required it were treated as a single hereditament in each of them in the central list. So the rule was abolished with effect from the 1st of April 1990. It had endured until then, and in no case had special circumstances been identified, not even British Transport Commission and Hingley, which led to the Port of Hull having only a nominal rateable value. The other reason for referring to Kingston is Lord Cave's description of how the profits basis was carried out, and it's on the screen. From the gross receipts of having told us about a bit of history, he went on to say, from the gross receipts of the undertakers for the preceding year, they deducted expenses, tenant's profit, the cost of repairs, and other statutory deductions, and treated the balance remaining as the rateable value of the entire concern. The combination of that description of the steps in the profits method with Lord Cave's insistence that, save in exceptional circumstances, waterworks should be valued by it, that combination tended to result in the description that I've just set out on this screen. That description being treated as more important and more hallowed than it deserved or Lord Cave probably intended. Now we'll come back to that. Before we do, I want to take stock of what we've seen in the 90 years between the Parochial Assessment Committee of 1836 and Kingston Union in 1926. My observations are not that dissimilar to those I made last time on the early years of the contractor's basis. The courts recognised that the task was to answer the statutory question, recognised that in answering that question, all the circumstances which would influence a negotiation ought to be taken into account, but considered it impossible to do that satisfactorily for the sorts of hereditaments valued by the profits basis. So they adopted a rough and ready hypothesis and applied it using rough and ready mechanisms. The rationale for the approach is readily apparent, I think. The profits basis is intended as an application of an economic theory of rent. Up to a point, it seeks to mimic the thought processes of a prospective tenant formulating his bid. When the hereditament is matched with non-rateable equipment, such as the trains on the track, its operation yields such and such revenues. Achieving those revenues involves me, the operator, in this amount of OPEX, that amount of expenditure on the repair of the hereditament. Excuse me. I will also have to pay rates as the occupier. I will have to arm myself with the necessary non-rateable assets, and that will have an annual cost, both in terms of the interest I've foregone by acquiring them and by depreciation in use. I also want a return for the risk I'm going to be taking and for my profit. Once I've made deductions for all of those considerations, there is a residue which it would be worth my while to pay the landlord. It may well be that I don't have to pay all of that rent, and that I can persuade the landlord to accept a lesser sum. But the figure that I identify is the figure I can afford. In the jargon, the difference between expected gross receipts and expected gross expenditure is described, not quite accurately, as the divisible balance. From the divisible balance, the tenant deducts his share to leave a residue available for rent. The problem with that method, the problems with that method are both theoretical and evidential, and a combination of the two. What I want to do from now on in this talk is to describe the way in which the method has been developed since Kingston Union by reference to a handful of themes which appear in headline form on this slide. The rating hypothesis, receipts, repair and renewal, tenant share. Under the heading of the rating hypothesis, I want to look in particular at three aspects: vacant and to let, risk of termination of the tenancy, and Rebus Sic Stantibus, which I enjoin to call the reality principle. Suppose you're valuing a railway. On classic general principles, the hypothetical tenant comes fresh to the scene to a hereditament that is vacant and to let. In the real world, a new tenant proposing to occupy such a hereditament would notice three things immediately. First, that it would take him quite some time to assemble a staff and the non-rateable assets he'd need to run the railway. Secondly, he'd realise that he would be raising a considerable capital to provide himself with the necessary non-rateable assets. And thirdly, that there was a significant risk in those assets from the fact that his landlord could put him out of occupation next year, potentially forcing him into a fire sale. All of that's logical, but its implications are unpalatable because they result in the conclusion that no tenant would take the tenancy. They use the concept of vacant and to let and the concept of a tenancy from year to year with only a prospect of continuance to deprive the rating hypothesis of the ability to identify the annual value of occupation. So in Railway Assessment Authority and Southern Railway in 1936, the first Lord Hailsham ushered all of them away. First, he says it must be assumed that there is in existence the present staff and management of the railway, and that the operator can reasonably expect to avail himself of their services. Forgive me, there's a typo in there, but I hope the sense is clear. He went on to say, in my opinion, it would be a mistake to allow the percentage to be influenced by the largeness of the sum which the tenant is supposed to apply for capital, or by the difficulty the tenant might find either in realising his rolling stock and other chattels, or in reinvesting so large an amount of capital on the expiration of his tenancy. Since the landlord is to be contemplated as a possible tenant, none of these considerations must be allowed to come in. Now, that reference to the landlord is peculiar. From the context, it's reasonably clear that he actually had in mind the owner, who would be landlord were he, as it were, to grant himself a tenancy. The idea, I suppose, is that the owner would carry on in occupation rather than accept a rent which was suppressed by factors that did not apply to his own position were he to occupy. In Hong Kong Electric in 2011, Lord Millett took it a little bit further. He described the purpose of the assumption that the tenant's assets could be acquired at market value without difficulty as being to ensure that all possible tenants are considered on an equal footing, and that the sitting tenant is not to have an advantage in not having to incur the expenses of moving in. In that case, the tribunal had found that the tenement, which is the term used in Hong Kong that roughly translates to our hereditament, could be operated only with the actual non-rateable equipment. So for example, the rateable settings and foundations for the non-rateable generators could only be used with those generators. That meant that the substantial profit achievable under a regulatory scheme of control, those profits were only achievable if the landlord and the owner of those actual non-rateable assets came to a deal. They had equal bargaining power. Now, the Court of Appeal, the court below the one in which Lord Millet was sitting, the Court of Appeal seems to have thought that this was to value the hypothetical tenant's assets in situ and to give the sitting tenant an advantage, and so to be contrary to the principle of Southern Railway. So it disapproved of the approach that the Lands Tribunal had taken. Lord Millet pointed out the fallacy of the Court of Appeal's analysis. He said that the hypothesis is necessary to allow the hypothetical tenant, and every possible hypothetical tenant, the ability to take over the existing business with the existing assets in situ as a going concern without interruption and without cost. In other words, there is no error, in this context at least, in valuing the non-rateable with the non-rateable assets in situ. Indeed, if you don't do that, the alternative to assume they have to be removed, and that leaves you with the problem posed by the time of that tooling up will take. But what then about the vacant and to let principle? Surely if you assumed that the non-rateable assets were in situ, you were not assuming that the tenement was vacant. The response was first exasperated and then reasoned. First, he said, with respect, the rating hypothesis is not completely absurd. Then he said that the purpose of the vacant to let assumption, at least insofar as it was raised in that appeal, was to ensure that the presence on the tenement of non-rateable assets didn't have an effect, positively or negatively, on the valuation. In the cases where the court had treated vacant as involving removal of the non-rateable assets, that assumption had been the convenient method of ensuring the desired end, namely that the presence of the non-rateable assets had neither a positive nor negative effect on the value. In a receipts and expenditure valuation, said Lord Millet, a valuation which by nature values the hereditament as an asset which is being used as part of a going concern, an assumption that the non-rateable assets have been removed is to undermine the valuation process. Now, I think I'd express it slightly differently, but I'd get to the same point in the end. In my view, the vacant and to let principle is not just about the presence or absence of non-rateable assets. It's also a necessary part of the assumption that the hereditament is available to any tenant who'd wish to bid for it. This is a new letting. The hereditament is to let and vacant in the sense that there is no sitting tenant. It's available to a new tenant. Whether the assumption of vacancy also carries with it the assumption that the hereditament has been cleared of non-rateable assets is a subsidiary question. And it's that subsidiary question that Lord Millet was answering. And although the answer was given in a Hong Kong case, I'd expect it to be followed elsewhere. Indeed, I think it's implicit in all of the receipts and expenditure cases I look at and in this talk, notably Southern Railway, which we looked at earlier. Now, thus far, I have considered the aspects of Southern Railway and Hong Kong Electric on the assumptions in the rating hypothesis that relate to the start of the tenancy. In Southern Railway, Lord Hailsham also said it must be assumed that the hypothetical tenant would be able to realise his stock at the end of the year as easily as he could acquire it at the beginning of the year at the market value prevailing at the respective dates. He must not be given a higher percentage on the basis that he may be unable to sell the stock at all. Now, in one sense, that is no more than the corollary of assuming that the hypothetical tenant has the ability to acquire those assets easily at the outset of the tenancy. But it also has the practical effect of salving the tenant's risk of having to sell his assets in a fire sale because the landlord chooses to terminate the tenancy. Again, what makes the counterfactual assumption both necessary and apt is that the failure to make it would threaten to reduce the rateable value as measured by the hypothetical bargain to a figure below the value of annual occupation to the actual occupier. Next, I come to Rebus Sic Stantibus. In the old cases, as far as I can tell, the hereditament was a pretty constant thing. And even if it was not, the prospect of change that would have value significance was suppressed by the approach of taking last year's accounts. However, the modern position is, I think, more complicated and as yet unresolved. Nowadays, as I'll come to in more detail in a few moments, the approach isn't simply to adopt last year's accounts, but to forecast revenues and expenditures. And to my lawyer's mind, that is the appropriate valuation approach, given that the rent is prospective. However, if you are going to forecast, then you need to decide for how long you're going to forecast and what you expect to happen in that period. I first came across the problem I'm about to describe in the BT 1995 list appeal, which settled on the steps of the Lands Tribunal. It has also arisen in a number of other telecom and water supply cases in which I've been involved, but for one reason or another has never yet been pushed to a decision. The point is this: we fix the hereditament as a defined corpus of assets at the material day. If it's a water supply hereditament, for example, it comprises inter alia the mains and pipes that existed on the material day, which is at least 2 years after the valuation date on which the starting level of demand is taken. From that somewhat artificial basis, we forecast receipts and expenditure, let's say for 5 years. The real world is not static. Over that 5 years, new housing estates will be built and the water supplier will construct new mains and pipes to service them. If my forecasts assume in year 3 revenues from a housing estate which was not connected to the water network at the material day, they are assuming at the very least a pipe which connects between the existing main and the new estate. In other words, they are assuming the existence of an asset which A, the rating system considers rateable, but B, is not part of the hereditament being valued. It's not part of the corpus of assets at the material day. So how are you going to deal with that situation? One answer might be to say that the rating hypothesis requires you to assume that the hypothetical tenant is barred from connecting the hereditament to any new demand, and on that basis exclude all expenditures and all revenues associated with that type of work from assessment. Now that involves quite a hasty departure from reality, especially where the regulated operator of the hereditament has a universal service obligation. Personally, I don't think that's what the rating hypothesis involves. In Ash Brothers and Heaton, we were told by Lord Wilberforce that if a construction programme is going to bring a motorway past the hereditament in 6 months' time, valuers are entitled to reflect it. By the same token, valuers ought also to reflect a competitor's anticipated rollout. If they're to do that, it seems counterintuitive to assume the hypothetical tenant is imprisoned in inactivity. In BT, we took the view that new lines could be assumed, and we went on as ratepayer to say that the new lines would be tenants' assets, because even though rating treats them as rateable once built, they clearly weren't part of the hereditament that the landlord was leasing to the hypothetical tenant. The valuation officer came round to that point of view at the time, but perhaps because there were a lot of bigger fish to fry. The position adopted by the VOA in recent water supply appeals has been different. They assume that the hypothetical tenant is absolved from all of the real-world regulatory requirements for enhancement of the network. The time may come when, if the VOA do not revert to their position in BT, the financial implications will be big enough to be worth what would be quite a complicated fight. Under the heading of receipts, I want to pick up three aspects. First, are all of the actual occupier's sources of income to be brought into the reckoning? Secondly, are we looking backwards or forwards? And thirdly, are the levels of revenue achieved by the actual occupier always the best proxy for the hypothetical tenant's revenues? The first of those is sources of income. The St James and Pall Mall Electric Light Company was heard by the House of Lords in 1933. The company was obliged by statute to transfer its undertaking to a joint authority in 1971, so some 38 years later, and to do so free of charge. In recompense, it was entitled year on year to include in its charges an amount which would create a sinking fund, which in 1991 would be equivalent to the value of the assets held by the company in 1925. Or at least that's what was said to be the case. The ratepayers argued unsuccessfully that the part of their revenues referable to this sinking fund payment should be excluded from the valuation. The court held that they received these sums as a result of occupying the hereditament. The fact that the sums were subsequently paid into the sinking fund was irrelevant. The valuation was not concerned with how the operator used the funds he received, it was concerned with the funds that would be received by taking occupation. In Mid-Northamptonshire Water Board and Lee, the issue was again whether a deduction should be made from receipts. The deduction claimed was equivalent to the sum which had been spent in the course of the year being assessed on interest charges in respect of works constructing assets that would, on completion, be rateable. Quite a complex concept. The ratepayers argued, again unsuccessfully, was that the revenue, which had been raised by precept, was not attributable to the hereditament and so should be excluded. The rationale for the decision against the water company starts from the observation of Lord Buckmaster in Port of London Authority and Orsett Union, that the actual hereditament to be valued is the particular hereditament as it stands, with all the privileges, opportunities and disabilities created or imposed either by its natural position or by the artificial condition of an Act of Parliament. In Lee, Lord Morton explained that the whole of the revenue from precepts was simply part of the revenue derived by the board in the year in question from the privileges described by Lord Buckmaster, and so fell to be taken into account. He also explained that the question is always what revenue can be obtained by the hypothetical tenant from his occupation of the hereditaments to be rated. I've seen it suggested that these two cases warrant the conclusion that if revenue is available to the actual occupier, it is to be taken as available to the hypothetical tenant and therefore included on the revenue side of a receipts and expenditure valuation. I question myself whether that's quite right. Suppose two ports, identical in every respect, save that at one, the operator is also the Conservancy Authority, and at the other, the Conservancy Authority is a third party. The operator of one port will receive conservancy dues. The operator, which is the Conservancy Authority, will receive conservancy dues, the other will not. The inference is that the operator of the port who does receive conservancy dues does not receive those dues as a result of its occupation of the hereditament, but from being separately the Conservancy Authority. To my mind, therefore, those conservancy dues would not be achieved from the occupation of the hereditament, and so shouldn't be included in the valuation. I take you back to Grand Junction Railway and to Kingston. I pointed out that in the first of those cases, Lord Denman clearly had in mind a negotiation about a tenancy that is about to begin, but nonetheless the value was founded on the previous year's accounts. Kingston established the profits basis as the prescribed method for public utility undertakings. The description of the method in Kingston was unambiguous. You started from the gross receipts of the undertaker for the preceding year, and then you made deductions. In Barking Rating Authority and Central Electricity Board in 1940, this led the Court of Appeal to say that in their opinion, it's settled by the two cases, Kingston and Southern Railway, that the profits basis has to be calculated not on what may happen in the future, but on the profits ascertained down to the latest period before the date of the rate, or in this case, the preparation of the valuation list. That is an extraordinary thing to say, given that there are dicta throughout the previous 100 years or more, that the question of fact to be answered is about a prospective rent starting from the valuation date. What the Court of Appeal is saying there also, it seems to me, doesn't have an economic basis. Lord Cave's comments in Kingston had been, it seems to me, hardened or distorted into a rule of law that you were obliged in valuing public utility undertakings to start from the previous year's accounts. Partly to get around the problem, at least in valuing hereditaments that were not public utility undertakings, the courts occasionally distinguished between the profits basis and a profits basis. So in the Chessington Zoo case in 1949, the valuers had forecast 5 years forward. The court described this as a profits basis approach. With the abolition of the rule of law about valuing public utility undertakings using the profits basis, with the abolition of that rule, it seems to me that there is no need even to pay lip service to the Court of Appeal in the perhaps aptly named Barking case. It is for valuers to identify how best to get as close as possible to the answer to the statutory question, and that is a question of fact for them and not for the courts. It may be that last year's accounts and accounts before that give good evidence which allows you to make a forecast. That's different, it seems to me, from saying you have to be backward looking in the way that the Court of Appeal suggested. Although relatively few receipts and expenditure cases have actually fought in recent times, quite a number have been got on foot. And my experience in every one that I've been involved with, from BT in the 1995 lift and onwards, and I've been involved with not just in this country, but also in Hong Kong, the experience throughout is that forecasts of revenue have been the starting point. The courts have always gone out of their way to emphasize that the method does not rate the operator's profit. The aim is to identify the value of the hereditament. Thus, while the facility that the hereditament provides for making profits is a matter that does affect value, it does not follow from that that the profits of the particular trader are a reliable measure of the value of that facility. Pubs are valued by reference to receipts. Some publicans are much better at the job than others. If the valuation were to be carried out by reference to the actual occupier's performance, good or bad, you would be breaching the injunction against rating the profits. So the approach is to identify the trade that the reasonably competent landlord would achieve, the fair maintainable trade, or FMT. In theory, that approach avoids the pitfall of valuing the profits rather than the hereditament. In practice, though, things appear less rosy. Back in the day, as my children say, the classic case was of a pub run by a former professional footballer. As it was expected that his celebrity would increase his trade, there was a presumption that the trade was more than FMT. Generally, although we all know from experience that some pubs are more successful than others, the reasons for that greater or lesser success are difficult to identify. And it's far from straightforward to explain why this pub does that amount of trade and the other 30% less. Is it the skill of the operator or the quality of the hereditament, its location and its facilities? Experience suggests to me that in practice, there is an overstrong presumption that the trade actually done is the FMT. And the notion that what's happening is not a tax on a particular operator's profits, but is on the FMT, is perhaps something of a fig leaf. I want to say a brief word about sinking funds now. The hypothetical tenant has an obligation to repair the hereditament and an obligation to maintain it in a state to command the rent. Now, there is potential overlap between the two. However, where the evidence so indicates, it is important to allow for both. In Birmingham City Council and Bromsgrove, the Lands Tribunal made a sinking fund deduction to provide for the renewal of the wasting parts of the hereditament over their lives. It quoted Lord Cockburn in The Queen and Wells from 1867. Provision made for a future liability to reconstruct is an expense which may properly be included among the expenses necessary to maintain an hereditament consisting in part of subjects perishable in a state fit to command the rent. To support a sinking fund allowance, the ratepayer needs to identify that the hereditament includes subjects perishable. That is, assets in respect of which a future liability to repair and reconstruct may realistically involve expense of reconstruction. The reservoirs in Birmingham and Bromsgrove, because it was another water case, didn't pass that test, but the water mains did. In Humber and Jones, the tribunal said that the question of the provision of a renewal fund will depend on two things. First, the type of construction of the building, for this affects their life, and secondly, the duration of the occupation. The point being that if you have a wasting asset and you expect to be responsible for it for a long time, then the prospects of your having to replace it are increased. And that is a prospect that generally is not allowed for in the allowance for repairs as usually calculated. The question is what a prudent occupier would do. In Brighton Marine Palace and Pier against Rees, the ratepayers engineer, Mr. Malone, mounted a beguiling theoretical argument for a sinking fund payment of £22,534. Inconveniently, though, there was a wide disparity, said the tribunal, between what Mr. Malone says the directors should have spent on renewing the structure and what they have spent. The sinking fund was allowed but at less than half Mr. Malone's figure. Tenant's share. Although the forecasting involved in the stages up to the identification of the divisible balance is not too far away from the sort of thing that businesses do in the real world, the assessment of the tenant's share has no real-world parallel. The Rating Forum guidance note of July 1997 on the R&E basis, which is perhaps a little yellow around the edges in other respects, correctly indicates that the tenant's share needs to be sufficient to induce the hypothetical tenant to take the tenancy, and so needs to cover his risk, the cost of the capital he employs, and to provide adequate profit. It is, though, easier to identify what is to be covered than how it is to be covered. From the cases, the JRF, the Rating Forum, draws attention to 4 approaches: a percentage of tenants' capital, a percentage of gross receipts, a percentage of the divisible balance, and an amount in keeping with the gross receipts, the amount of the tenant's capital and the divisible balance, that is a spot figure. A comparison from the 19th century cases illustrates why no set approach can be adopted. The tenant's capital required in a gas undertaking was always considerable, and all agreed that a percentage on that capital was the right or a sustainable approach. In water undertakings, on the other hand, the amount of the tenant's capital was generally found to be so small in relation to the size of the undertaking that no ordinary percentage applied to it would produce a sum sufficiently large to induce the tenant to become liable for the rent. It was therefore customary to calculate the tenant's share of a water undertaking by applying a percentage to the gross receipts. Before I look at recent cases, I return to Southern Railway because there is one point of law which is both important and helpful. The Railway Assessment Authority argued that the apportionment of the divisible balance should be made upon consideration of the respective amounts of capital staked by the landlord and tenant in the undertaking. At first instance, a court that no longer exists but was called the Railway and Canal Commission Court, in that court the argument was rejected for a number of reasons, and one was that as the value of the hereditament to the landlord can be nothing else but the rent which some tenant will give, the assessment of the capital value to the landlord requires first the assessment of the rent. Another reason was that the arguments involved assuming that the hypothetical parties were, in the words of the day, joint adventurers. The first instance decision was upheld in the House of Lords, which made it clear that the hypothetical parties were not joint adventurers. Lord Hailsham said, if the amount which the tenant would require is deducted from the total net receipts, the result is to divide the net receipts fairly and justly between the landlord and tenant, even though in an extreme case, the landlord's share might be nothing at all. So the first call on the divisible balance is the tenant's share, and the landlord should receive no more than remains after the deduction of the tenant's share, even if, as it was in the case of BTC in Hingley, the result is nil. The fact that the Joint Rating Forum guidance identifies 4 possible approaches, the fact that there is little guidance about how to choose between them, the fact that there is little guidance about how to use them, and the fact that one of them is a licked finger in the wind, all emphasize that we are traveling in terra that is largely incognita. Into that territory stepped the economists who gave evidence in the first China Light and Power case. There is logic in the proposition that the hypothetical tenant would only take the tenancy and invest in the non-rateable assets and working capital necessary to operate it if he was satisfied that the investment would at least maintain the value of his shareholders' investment. The economists say that for the hypothetical tenant, this threshold is identified by his weighted average cost of capital. The acronym is WACC. So 2 numbers appear to be useful to us: the value of the tenant's capital and the hypothetical tenant's WACC. If we apply one to the other, we get the number below which the hypothetical tenant will not go in terms of his share. Generally, the assumption is made that the value of the assets which the tenant would require is the depreciated replacement cost of the actual occupier's non-rateable assets. That's not an entirely satisfactory assumption, and there are some instances in which it may be false. But 9 times out of 10, it's the best proxy available. The heroics involved in any other assumption are usually even greater. As for the WACC, I make 3 points. The first is that whilst WACC is, if I understand the economists, the threshold percentage below which the hypothetical tenant would not deal, the cases all apply WACC as the measure and assume in effect that if there were any higgling, the tenant would lose out. And that, it seems to me, ain't necessarily so. The second point I want to make about WACC is that the evidence for WACC usually involves trying to identify the WACC of an owner-occupier. That's the closest proxy we have in the real world. Whereas the aim is the WACC of the hypothetical tenant. The actual occupier differs from the hypothetical tenant in 2 important respects. First, the actual occupier has a stronger asset base because it owns the rateable as well as the non-rateable assets. Secondly, it doesn't have the hypothetical tenant's liability to pay the rent that we are calculating. I find it a little surprising that as yet, no tribunal has seen fit to adjust the WACC it uses to reflect these features and to reflect the difference between the actual owner-occupier and the hypothetical tenant. The third comment is that there are different means to identify WACC, and they involve some leaps of faith, which should not, in my view, appear less substantial just because responsibility for them is outsourced to economists. Recently, we've seen an alternative fashion, namely for splitting the divisible balance. Here, once again, Hong Kong has led the way, notably Hong Kong Electric, which was followed by the second China Light and Power. In those cases, the regulatory scheme of control had been set when interest rates and hence costs of capital were much higher than at the time of the valuation. The commissioner argued that the hypothetical tenant would accept as its share WACC times the replacement cost of the tenant's assets, thereby by allowing all of the super profit to the landlord and the rateable value. The tribunal decided that the tenant's share would equate to the proportion of the profits that under the scheme of control its tenant's assets drove. And that brought the rateable value down much lower than suggested by the commissioner. Now you can look at that decision in different ways. You can see it as an example of the higgling of the market, the outcome of negotiations in the particular circumstances, including that the only assets which could drive the revenues were the particular tenement and the particular non-rateable assets. You can see it as based on the proposition that the value of the tenant's assets is the present value of the future income that they will drive. So if you are to apply a contemporary WACC, you apply it not to replacement cost, but to the higher figure derived by capitalizing the future revenues, using the WACC as the discount rate, bringing you to the same answer. Or you can say that it's a set of circumstances in which a percentage of the divisible balance was considered a more appropriate measure than a return on the depreciated rate replacement cost of the tenant's assets. All of those are true in their way. The point I want to emphasize is that however you look at them, the decisions are decisions on their shared but unusual facts and are not a blueprint for deciding all cases on a percentage of divisible balance basis. Indeed, whenever you're considering a split of the divisible balance, you need to be careful to show that you are not, in effect, treating the hypothetical parties as joint adventurers. I just refer back to the things I said earlier about Southern Railway. Finally then, I will leave you with a quotation from Lord Millett in Hong Kong Electric. The receipts and expenditure method is only an aid to the ascertainment of the rent which the hypothetical tenant would be willing to pay. It's not an inflexible code of rigid rules. The valuation must take account of every intrinsic quality and every intrinsic circumstance which tends to push the value up or down. The methodology must be sufficiently flexible to accommodate any feature which affects the amount of rent, whether it is common or rare. Thank you very much for making it work through to the end of this, the second and final talk. Thank you and goodbye.